Welcome to today's Explainer. I am absolutely thrilled to have you here because today we are unraveling a massive financial mystery. We're going to pull back the curtain on the stock market to look at the actual raw mechanics of what drives prices today. Specifically, we're zeroing in on the mechanics of a short squeeze, and we'll be looking at a wildly illogical event from this past April, a massive market rally that honestly seemed to make zero sense.
Okay, let's dive into this. Traditionally, we're taught that markets absolutely hate uncertainty. War, geopolitical chaos, supply chain disruptions, all these things are supposed to be terrible for business. Yet, time and time again, we watch global conflicts escalate and the stock market somehow hits all-time highs. It completely defies logic, right? Well, today, we're going to use the data to show you exactly why that happens.
Section 1. An illogical market rally. Before we can even begin to understand the mechanical forces that drove the market up, we really have to look at just how terrified Wall Street was going into this whole event. It was a truly chaotic period. On February 28th, right after joint airstrikes, Iran shut down the Strait of Hormuz. The market went into this brutal 5-week losing streak, dropping nearly 9%. By mid-March, commodity analysts were in full-blown panic mode. They were predicting that if the disruption continued, we could literally see oil hit $250 to $300 a barrel. I mean, that's a scenario that would trigger a global depression. Wall Street was terrified. But then, suddenly, on the evening of April 7th, a ceasefire was announced. And the very next morning, it was like someone had flipped a switch and turned the money printers back on. The numbers were just staggering. Over 400 names in the S&P finished green. The Dow exploded upward by more than 1,300 points, its best day in almost a year. The Nasdaq climbed nearly 3%. Traditional financial media immediately hit the airwaves, blindly celebrating this as a classic relief rally. They were telling the public that the markets were just, celebrating world peace. Now, what's really interesting about this is how that mainstream narrative of world peace falls apart incredibly quickly when we look at the hard data. There's this maritime intelligence firm called Windward, and they use AI to cross-reference GPS signals and satellite imagery in the Strait of Hormuz. Well, their data showed that on the day of this massive rally, only 5 outbound carriers were detected moving through the strait. That is a 96% decrease in activity compared to the pre-war baseline. There was absolutely no relief. The shipping lanes were still functionally closed. Which brings us to a really crucial question. How can there be a relief rally based on world peace if there's actually no world peace? Think about it. If the conflict was actively continuing and global shipping was still frozen, why on earth was your retirement account soaring? If world peace didn't move the markets that day, something else entirely did. And to find out what, we have to look under the hood of Wall Street.
Section 2. Mechanics of a short squeeze. Going into that April 7th ceasefire announcement, hedge funds had been panicking. Prime brokerage data from Goldman Sachs showed hedge funds were selling at their fastest pace in 13 years. Their short exposure, meaning their bets that the market would go down, was sitting at the highest level since the pandemic. So how does this work? Well, when you short a stock, step 1 is you borrow shares and sell them, hoping you can just buy them back later at a much lower price. But in step 2, if the price actually rises instead, say because a sudden ceasefire hits the news, you are losing money, fast. That leads to step 3. Your broker issues a margin call, basically demanding you either deposit more cash or close your position right then and there. And step 4, to close that position, you are forced to buy back the shares at that new, higher price. When thousands of traders are forced to buy at the exact same time, it launches the price even higher, which triggers more margin calls and more buying. It's this wild, vicious cycle. These are the exact mechanics of a short squeeze.
Section 3. The 3 falling dominoes.
The incredible thing here is that the massive short squeeze we just broke down, that was only the first domino to fall. It was just the core mechanical catalyst that ignited a much, much larger chain reaction involving CTAs, or commodity trading advisors. So these are systematic trading firms. They do not care about geopolitical news, they don't read earnings reports, and they certainly don't care if there's a ceasefire. They run on pure mathematics and rules-based models. Going into April, these blind algorithms were sitting on a $30 billion net short position. But the very second that short squeeze pushed the S&P across specific numerical trigger levels, these algorithms mechanically flipped. And they didn't just flip to neutral, they aggressively went long. Over just 5 trading sessions, these algorithmic models mechanically bought $86 billion worth of equities just to exit their shorts and ride the upward trend. To put that into perspective, according to Goldman Sachs, this $86 billion buying spree was a top 5 speed print of all time.
Then came the third domino, the options market. Heading into this event, financial data platforms were flagging that we were in a negative gamma regime. That sounds complicated, but basically it's a highly mechanical state where options dealers, who legally have to keep their books balanced or delta neutral, are forced to act procyclically. This simply means that as prices went up because of the initial short squeeze, and then the algorithms piling on, dealers were literally forced to buy the underlying stock to hedge their massive options risk. And of course, that just pushed the price up even further. So, you see, the April rally wasn't about world peace or economic relief at all. It was a mechanical recipe. First, the short squeeze sparked the fire. Second, the systematic algorithmic flip poured gasoline on it. And third, forced dealer hedging blew the roof off the whole thing. These three dominoes falling in sequence created an explosive rally that was completely, totally detached from the actual reality of the Middle East conflict. Section 4. The passive market shift. Now, what's absolutely fascinating is that this isn't just some rare, one-off event. We saw this exact same mechanical pattern happen in December 2018 when the Fed chairman merely said the word patient, and we saw it again in August 2024 when the yen carry trade unwound. To understand why this keeps happening, we really have to look at how the foundation of the stock market has fundamentally shifted. 20 years ago, the market was dominated by human beings carefully analyzing cash flows. But today, 63% of all US stock funds are held by passive indexers. That represents more than $13 trillion of blind money that simply follows an index on autopilot. It doesn't care about the news, it just blindly buys. And because these passive funds are mostly market cap weighted, it creates this phenomenon of allocation by default. Basically, the bigger a company gets, the more the passive funds automatically buy it. That is mechanically how the Magnificent Seven tech stocks have grown to make up over a third of the entire S&P 500. A massive chunk of the market isn't being carefully analyzed for its true value anymore. It's just blindly receiving capital. And hey, even the 37% of the market that's still considered active has fundamentally changed. The industry has consolidated into these giant multi-strategy funds, think Citadel or Millennium, and they operate with 4 to 8 times leverage. Because they are so highly leveraged, they have to employ really strict mechanical drawdown rules. When a loss limit is hit, they don't sit around in a boardroom debating global macroeconomics over coffee. They just execute a mechanical sell order immediately. And underneath all of this passive and algorithmic money is the absolute final piece of the puzzle, the modern options market. Today, same-day expiration options make up around 63% of all S&P trading. On peak days, we're talking about over $2 trillion of notional value changing hands. Every single one of those trades forces a dealer on the other side to hedge in real time, creating this constant, massive, mechanical buying and selling pressure. Section 5. The new feedback loop. When we pull all of these data points together, a pretty startling picture emerges of the world we're investing in today. The old stock market, the one we all learned about in school, where savvy investors found undervalued companies and held them for the long term based on strong fundamentals, that market is largely gone. The new market is just a giant mechanical feedback loop. The dominant players aren't analyzing valuations anymore. They are simply reacting. And when prices move, their automated reactions stack on top of each other, creating these massive, seemingly illogical swings. So when the market exploded by 1,300 points in April, the media called it a relief rally for world peace. But as we've seen today, that was a complete illusion. The headlines? They're really just comforting stories we tell ourselves to rationalize the wild mechanical movements of algorithms, short squeezes, and automated dealer hedging. Which leaves us with this. If the old market of fundamental analysis is truly gone, replaced entirely by blind money, algorithms, and strict mechanical rules, who's really driving the prices in your retirement account? It's a fascinating question, and one that should fundamentally change how you view the daily news. Thank you so much for joining me for this explainer, and as always, keep questioning the narrative.